Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hey, welcome everyone to the SED conference call. Today we've got something quite special, not the typical sort of company interview. We've got two companies here that will soon be one. So happy to have both Travis McIntyre, CEO of CanadaBis Capital, and Jeff Swainson, CEO of Simply Solventless Concentrates. CanadaBis, and I always mix up the names, so if I get it wrong, you guys correct me, but I'm going to say CanadaBis Capital, CANB on the venture exchange, and then Simply Solventless, of course, hash HASH on the venture exchange. Guys, we both got you here, but before we kind of dive into what's transformed here today, Travis, why don't you tell us about CanadaBis, and then Jeff, I'm going to ask you to do the same thing. So tell us a little bit about the business.
Yeah, appreciate it, Paul. Thanks for having us on here again. Obviously, it's always a good time to be on the show and pushing us forwards and getting the reach out to our investors and our loyal guys that have been with us for a while. So thank you again for that. Yeah, CanadaBis Capital. Really, our focus is our Stigma Grow play, which is our LP that's located in Red Deer, Alberta. We've I'm going to say over the past 4 to 5 years, again, we've transformed what was the landscape of, hardly any concentrates / infused product lines into, what it is today. And we've pioneered a lot of those product types and those product lines. And I'm really proud of kind of being a leader as well as Jeff in profitability in the cannabis space. I think, it was an unheard of event for a long time. And we really buckled down and got what a real company should look like, and then how that forms obviously into the bottom line. So, we have great innovative products. We will continue to innovate in the space as we go forwards with both ourselves and in the combination. And realistically, I think we're going to see a bright future in Stigma Grow / CanadaBis Capital's world. And we just would like to absolutely thank our current shareholders and our future shareholders for being with us.
Fantastic. Thank you, Travis. And Jeff, remind us what hash is all about.
Yeah, so we're a fundamentals-focused licensed cannabis producer and processor. We're focused on branded organic revenue growth of our house brands that we started to launch in early 2023, and then also on opportunistic acquisitions, and in this case, amalgamations. We're very bottom line driven. We're net income focused, not even EBITDA focused, but net income focused, full cycle profitability. And really what we're trying to do ultimately is to build credibility with not only investors, but with other licensed producers and all stakeholders, so that we can kind of be a part of writing the cannabis industry ship and making it what it can be. We really believe in the space and the upside in the space. We believe we're at a significant inflection point for investors in the space, where, of course, there's been a significant lack of capital for years, and there's a lot of distressed assets out there, and then there's some operators that have risen above and developed strong operating businesses. And so that's why I'm excited to be here today, obviously, is because with Stigma and Travis and what we're putting together here, it's really the unification of two of the stronger LPs in the space, in my opinion. So hard to follow Travis's act there, but ultimately we're aligned with Travis's vision as well, and we're focused on fundamentals and profitability and execution.
Fantastic. I want to remind everybody at some point I'm going to ask you guys all to, if you've got questions, to offer up your questions, and we can ask Travis and Jeff. But maybe before we get there, why don't we talk about some of the highlights of this transaction? I mean, this is obviously transformational for both of you. Jeff, we'd spoken briefly earlier. You really highlighted the fact that this is probably the sweetest deal you've transacted here, because it is a significantly viable, real well-run business, profitable. I mean, unlike a lot of the other assets that were distressed, you've got something here that's significantly more powerful. And but what does it add to your business?
Yeah, and so this transaction is truly transformative. I mean, that word is thrown around all the time, but throughout our history and our our acquisitions in the past, of course, they started out very, very small. Just the acquisition of just intellectual property, product listings. And now we're at the point with this transaction where we are putting something together with significant critical mass. We're talking about 100 million annualized revenue, north of 20 million annualized adjusted EBITDA. The synergies are far-reaching operationally. So Stigma is number 6 in pre-rolls in Canada, excluding Quebec, is from our analysis, and we have some of the best pre-rolling capability in the country with ANC. So an immediate synergy there in terms of pre-roll manufacturing and cost savings. Of course, Stigma is focused on hydrocarbon extraction, which we were implementing in-house, but we'll now put a pause on that, of course. And we're focused on solventless extraction and pre-roll manufacturing, and so there's huge synergies just in terms of manufacturing capability. And then in terms of our philosophies and how we run the business, we're profitability focused, fundamentals focused. We want to run a lean team, and Stigma was the first profitable LP that I'm ever aware of. I mean, they've been profitable for 13 straight quarters of EBITDA, and so bringing these companies together really drives the profitability mandate. It allows us to capture further synergies, whether it's facility rationalization or what have you. But ultimately, there's not many win-wins out there, and when you look at this deal, it's just so plainly obvious a win-win. The CANB shareholders receive a significant premium, 78% to their 30-day VWAP. Almost double EBITDA multiple from what they were currently trading at. And then, on our side, we acquire a highly profitable, successful business with an incredible team for 5.9 times adjusted EBITDA on pre-synergy EBITDA levels of 2.7 million. But when you start layering in the synergies, the EBITDA multiple drops to 2 times. And then when you start, layering on the fact that Stigma owns the real property and it's got significant tangible real property value, it kind of brings the multiple down for us. So I think it's good for all parties. It's a win-win, and really makes us one of the most formidable licensed producers in the country.
Fantastic, Jeff. Travis, you're already a healthy business. We were starting to see some significant sort of traction and success. Why do the deal here, and where do you see the upside, and how does this sort of benefit, let's call it your business strategy going forward?
Yeah, I mean, that's a great question. We've been in the space for going on 8 years, from kind of inception to what we are transformed today. We've seen the highs, we've seen the lows. We've been really fortunate to build a company that's kind of lasted the time and really set it up for the future here. But there comes a time where over the past 12, 18 months, we really were looking for a good dance partner. And not that we don't take our internal growth seriously, but I think when we start looking at the cannabis industry on a whole, what becomes very apparent is, there's some critical size, some critical mass that needs to be obtained. And there's some opportunities out there. And this combination we felt was an opportunity. we have looked at a lot of deals in the past. We've looked at a lot of opportunities. Some were just not at the right timing. Some weren't at the right levels. And when we look at it from, where maybe our share price was at a peak over the last 5 years to, maybe it is now, unfortunately, the sentiment in the market is not as strong as, what we would hope it would be. It's I'm going to say at the size we were. Now, that changes with this deal, and it really pushes into the next level of, I'm going to say a real company that's at somewhat of a size. And I truly kind of believe over the next 18, 24 months, the winners coming out of this are going to be, an LP / company that's going to be of a critical size, that's going to be profitable, that somebody can sink their teeth into and say, yeah, this is a real good investment opportunity long term. We're not both turning 1 quarter of profitability and saying, hey, look at us, look what we did. It's, we've got some long-term track record behind us. And that's what, in my opinion, people want to see. And that's what I would want to see as an investor. And that's really what we've tried to be a good steward of to our shareholders is how do we maintain and give some good legs to a company in this, what we call, mixed mash of an industry that we're in. It'll get better. We know it'll get better. The changes brought forth today by Health Canada are always improving. It's going to take years to make this industry into what we would, obviously, everybody was a pipe dream that it was going to be a 1-year transformation and life was going to be amazing and unicorns and rainbows. But I think we're really down the next level, and we're on a stretch that it's not unicorns and rainbows day one, and the strong will survive. And this is a strong deal, and coming together with these 2 strong companies really provides value for our shareholders, and it provides value for SSC shareholders that we have some, we didn't pick a bad dance partner. We've got some great synergies going forwards on like Jeff explained, and that just leads and lends open to possibly more market share as we go forwards. It gives us some strength and some buying power, purchase power, some synergistic, some product types. All of that comes into play when we start looking at two good companies, and this is what's needed to happen for the last 18 months, in my opinion. It just kind of took this long to get together and really lay the groundwork to see something successful.
Mm-hmm. Yeah, it seems the more I understand the transaction, the more I like what I hear here. There's really some nice sort of dovetails of the business. You operate in parts of the market that simply isn't in, and vice versa. You guys have products that simply doesn't have, and vice versa. I mean, there's a lot to unwind here. Maybe let's talk about geography first. Like, where do you see the opportunities geographically? Either you can answer this, but geographically where you weren't in, and maybe now you can be stronger. I know some of your products combined, you now have, I call it top 3 categories in some spots now. Let's talk about that geography sort of upside from this transaction.
Yeah, well, realistically, I think that's part and parcel to it. I mean, when we start looking and running down our SKU counts, I mean, we're sitting up over 600 total SKUs in Canada listed today. Now, obviously, that's compounded across all the provinces and territories and what have you. But when we look at a little bit of cross branding and cross productivity, that just skyrockets that SKU count. And I'm sorry we haven't done the total SKU count between Jeff's brands and ours, but it's substantial. We're not playing in the small leagues of 1 or 2 or 3, and we have great provincial relationships, and we do pride ourselves on that. So whether it's weak in BC and strong in Alberta, or strong in Alberta and weak in Ontario, when it comes to what maybe there might be some duplication of SKUs, we don't find there's a bunch of duplication of SKUs across all provinces. It might be, again, it's, and I'll use an example, royalty shatter might be, substantially stronger than ours in Ontario and vice versa, how it plays out. But that's the best part about this, is that we get to now spread our wings across all of Canada, and gain some of that profitable market share where all the brands are playing.
Mm-hmm. And Jeff, maybe you touch on some of the things that you see as far as opportunity geographically.
Yeah, and so for Simply, the primary market that we are not in right now is BC. And of course, Stigma is quite strong in BC, with a presence there for years with DAB Bods and Stigma Grow. So for us, by proxy, it allows us to participate in the BC market, and hopefully with that toe in the door, will help us to segue our other brands into that market. And just, if you look overall, we're both in Ontario, we're both in Saskatchewan, Manitoba, a little bit of Maritimes, but really what excites me is just the aggregate market share. I mean, we Simply Solventless is something like 4th in concentrates. I believe Stigma's 6th in Canada, excluding Quebec. Together, we're number 2. I mean, number 2 in concentrates is significant because these are high dollar products. These are connoisseur products. These are products that true cannabis enthusiasts love, and they have a higher register, receipt per transaction. And then pre-rolls. I mean, pre-rolls are essentially as big as the dried flower category now, or close. With our manufacturing capability, we obviously wanted more market share in pre-rolls, and Stigma, between their brands with DAB Bods, number 6. And so all of a sudden we're top 5 in pre-rolls, in really the largest category in the market. And so we're really becoming substantial in terms of market share. We're bringing profitability along with it. We've both started as profitable companies that were small, that have now gained some scale and brought that efficient operating mandate to the bigger operation. And so now when we're together here with the kind of scale that we're looking at, with starting to achieve top 5 market share positions, it's really substantial for us. And, as you can see here, we're not going to talk about the future, I think, but we need to work on that vape category a bit. And so it's becoming clear where, where the strengths are and where we can improve and gain market share. But for Simply getting into BC and getting a lot of our brands into BC, behind DAB Bods and Stigma, would be meaningful in terms of organic revenue growth.
Mm-hmm. Jeff, you mentioned you're both running profitable companies, and you both, I find it coincidental that you're both ex-oil and gas industry guys. Is there a connection between coming from that industry and running a profitable cannabis company?
Well, Travis, do you want to take that first?
I guess you live and die. If you can't make money in the oil and gas industry, you die pretty quickly. But there's got to be something in your blood that's causing you guys to make money in this business where most people can't.
Well, I think it's just honestly being a good steward of the capital. I mean, and by that I mean making sure that, when we bring in a dollar that, it should better only cost us 80 cents to build that, or what are we doing? We're looking at that saying, I guess oil and gas doesn't have safety nets, as want to say, we can't walk down the street and say, hey, we have this crazy idea. Can you give me $200 million? And somebody says, sure, that's great. We'll just do that. That doesn't apply, right? So, really, I think it comes back to playing in a mature market, whether that's oil and gas or CPG or whatever it may be, has that tendency and has that to really smarten you up on making sure that every dollar counts. And that's really how we've played this, is every dollar that we've ever raised, or every dollar that's, come into the facility has to make it work. And it has to work for us, whether that's, on a return on our investment, or if it's, simply that's improvements along the lines that will produce an ROI. It's just being a good steward of that capital. And I think that's, basically all it is. It's not rocket science. I get it. But, and this isn't, and don't get me wrong, this isn't an easy industry to be in. And this, you have to have good products. You have to have, you know, some quality behind you. You have to have some good branding. And you got to have a little bit of luck too. Don't get me wrong. I mean, this is, you know, you got to have, making sure that somebody's actually touching your product and saying, yeah, I enjoy that and I want to buy it again. You know, there's a little bit of science behind it, but it's a lot, you know, some luck as well. So, yeah, I guess from my standpoint is really that, just a good steward of capital, and it does go a long ways.
And just to add to what Travis said there, you know, I think Paul, Trevor, you've heard me say many times, every dollar matters. That's one of our internal, you know, mantras. And Travis said every dollar counts, but it's the same thing. It's that mentality on shrewd capital stewardship. And then, you know, to add to that, oil and gas is cyclical, and it's ups and downs and ebbs and flows. There's capital availability, there's no capital availability. It's a commodity-based business. And as they say, there's more money made in oil and gas when there's blood in the streets of Calgary than any other time. And so for how it relates to us, obviously the capital stewardship is, you know, one of the reasons that perhaps oil and gas, you know, backgrounds are conducive to success in cannabis. But here we are in the industry in a trough. We're in a very difficult time where there is very, very tight access to capital. And as a result, you know, we've weathered these kind of storms before. We look at these kind of storms as an opportunity, not a problem. And so, you know, that's what we're doing together is we're trying to capitalize on this event. And you know, from a contrarian type of a perspective, and operating and executing a business plan that can, you know, generate value out of these challenges.
Awesome. Now, it's good to hear that whole idea of cyclicality and buying when there's blood in the streets. I think that's one of the reasons we're so almost infatuated with the cannabis sector now, is just that we see tremendous assets that are getting picked up and in the right hands are getting, you know, properly utilized. Guys, I want to dive into some of the synergies that you've touched on so far. And one of the ones that stood out to me, and maybe you can help me, you know, help communicate it to the audience here, is that, you know, CanadaBis is one of the bigger pre-roll, you know, sellers in the market, and ANC is one of the biggest, you know, pre-roll companies. But CanadaBis, Travis, you weren't using ANC before. And correct me if I'm wrong on any of this stuff, but there's a huge opportunity now switching that manufacturing to ANC. Is that correct, guys?
Yeah, I think yeah, we do a lot internal, and we do have third-party partners currently, but realistically, it makes a big difference for us, and it's scalability, right? So as that scalability and we can keep the revenue in house does make a difference. Obviously, as a combined pro forma entity.
And maybe touch on some other synergies you see, immediate opportunities to maybe take advantage of capacity, underutilized capacity, or equipment, or anything. I mean, Jeff, you touched on you were going to get into certain parts of the business now that you don't need to because Travis already does that. Maybe let's get a little more detailed into some of these things.
Yeah, so aside from pre-rolls, the one that comes to mind the most is that, you know, Stigma is actually cultivating cannabis. And, you know, with the Delta 9 acquisition, clearly, you know, we have 98,000 square foot indoor cultivation facility that cultivates very high quality cannabis at scale. Stigma's cultivation operations can come over to Delta, and that frees up processing room for, you know, maybe some processes at one of our other facilities can go into Red Deer. And so there's all kinds of operational opportunities there to capture as a result of this. We haven't even fully unpacked them all yet, but you know, the synergies are absolutely substantial, and we can leverage each other's core competencies. You know, we are about to you know, to get into hydrocarbon extraction, and although, you know, our team is very skilled and we have a lot of hydrocarbon experience at other companies, it's not like actually commercially producing it at scale for a long period of time like Stigma has done and successfully executed. And so, you know, at the end of the day, on a pro forma basis, we have 200,000 square feet of cultivation and manufacturing capacity, in multiple provinces, where power is cheap is where we cultivate, and where labor's strong is where we're manufacturing, and things just kind of make sense that way. Travis, I don't know if you have anything to add on the overall synergies there, but from procurement, it also makes a big difference just with the economies of scale, using each other's inventory, right? Any product that Travis needs, that's a solventless product, we can provide, and anything with a hydrocarbon, like we have, Fruity Hootie, Royalty, these brands, Zest, they all use hydrocarbon concentrates, and we're purchasing all of those third party right now. So the inventory utilization, the velocity of inventory turnover, I mean, the synergies are pervasive across the board.
Yeah, no, I agree, Jeff, and I think that's, obviously we talked about it in length, but that is really the icing on the cake here, is being able to utilize a lot of these different profiles and product types into our current brands. I mean, there's just synergies there that, again, we haven't unpacked everything, because I mean, we're going to be a while doing it, and we have a great plan forwards to do so, and we've hit the main points. But I think as we dive deeper and deeper and deeper into how we can really assist going on a pro forma entity, it's I don't think we can even describe it yet.
Yeah.
Awesome.
Yeah.
Awesome.
And in terms of the critical mass, Paul, sorry if you're going to ask a question.
No, go for it. Go.
On a combined basis, we have upwards of 56 million of net assets. You start looking at the balance sheets across, LPs in the industry with very, very meaningful revenue levels. We're right in that ballpark, right? So we have the asset base for that critical mass, the working capital pro forma, 22 million. That's a substantial amount of working capital. A lot of that obviously is monetizable, high quality inventory that we can both mutually use, right? And so if we're both successful before and both able to achieve revenue growth with this asset base and our teams, teams that have been in the trenches for 5 years in this industry, that have that are here today, frankly, that are here today with the fundamentally strong business, that really bodes well for the future.
Mm-hmm. That's fantastic. Okay, so let's talk about some of the assets you've acquired. What are we acquiring as far as hard assets and anything else you can talk about that?
Yeah, and so obviously Stigma, they own their real property, so I believe it's just over 9 acres of land with the facility with a 22,000 square foot floor plate, 2 floors, so 44,000 square feet, room for expansion. And it's right near Gasoline Alley in Red Deer, in a great area with great infrastructure right up to the door. So that's the real property, and of course we don't necessarily believe that owning the real property is the best play going forward, and so collectively we're looking at potentially doing a sale leaseback transaction to take that off the books and ensure that the balance sheet is as clean as possible. And so that's a really big opportunity for us going forward in terms of strengthening the balance sheet, adding cash, reducing debt, reducing payables, just having that clean balance sheet so we can achieve higher multiples. I mean, as you can see on this slide, and maybe we'll get into it on the next one, but pro forma at these price levels, we're at 3.9 times adjusted EBITDA. And our opinion is any industry should have any industry with a fundamentally sound business should be at a 10, right? Mm-hmm. And so we're fundamentally undervalued. We're fundamentally undervalued despite the revenue growth, despite the access to capital, things like that, and the track record. So I think that we can basically leverage the assets of Stigma, so that as a combined entity we can move forward as clean as possible and achieve the highest multiples possible.
Mm-hmm. You know, in the press release, you guys announced a $2.5 million convertible debenture raise. Maybe let's talk a bit to that. What's the idea behind that? You know, can we participate if somebody was interested? What can you tell us about the financing? Maybe Travis, I'll give that to you.
Yeah, thanks. Yeah, right now it's a brokered financing. Research Capital has taken that mandate on as of today. We're working towards rounding it up and getting done, and obviously we can work on participation. I think there's some boundaries around that. I can get all the information for that.
Mm-hmm.
But yeah, I mean, really, as realistic use of proceeds, we're on a growth trajectory, so we're moving at the lightest speed here, and you know, building inventory for product launches. Obviously, you know, Jeff mentioned it earlier, the vape category. We felt very underutilized and very under supported in that in the past, and our our customers have been asking, hey, can you do this? Can you do that? Can you do this? And we really looked at it. We've stayed away from it for a while. You know, hardware is always an issue. It's tough to maintain, you know, proper usage of the hardware that you do get. But you know, we've kind of been in a black R&D phase for close to a year now, and we felt that, you know, we've got the right suitable recipe to come back out into that space and launch under our Vero brand and really take some market share back and take it by storm. And so that's, you know, capital intensive for sure. I mean, obviously, product launching, you know, inventories, we've got, you know, we've got marketing strategies that has to go along with that. So that's really on the back of this thing. We're looking at the forward future here and making not only what was going to be or what was, you know, CanadaBis Capital on a standalone, but also making the pro forma entity, you know, into SSC, a much stronger company coming out of this, you know, with that extra brand and extra market share going forward. So, obviously you know, this was a fairly, you know, quick call to doing the market, but you know, we're pushing forwards and we're pushing the envelope like we always have, and that just unfortunately costs money. So that's really where we want to be prepared and do it right, so that we have the biggest market splash that we can when we do launch these products. Yeah, and you know, we're getting traction with, you know, the OCS and with AGLC and other, you know, BCLB, as Jeff mentioned. You know, we have really good partnerships over there. So when we start to launch a brand, or we start to launch a new division into our pre-roll lines or what have you, they want it. They want to take it all up. So it's kind of it's a catch-22, but you want to, again, be a good steward of the capital that we do have and maintain profitability. But in the same aspect is, you know, we've got hungry clients that we can have some growth potential with, and we're willing to oblige that.
Mm-hmm. Guys, I mean, as you guys have more heft here, size, how does that affect suppliers and customers, I guess, to some degree? I mean, you know, Jeff, we've always talked about how so often participants are either not trustworthy or people can't pay their bills, things like that. I got to imagine the bigger you get, the more clout you get like this, you probably get, you know, call it better deal terms when you're dealing with some of your, you know, suppliers and customers. Maybe talk to that.
No question. Yeah. Oh, Travis, were you going to cover that?
Either one of you guys.
I real quickly, and I only have one thing to kind of say on that is, yeah, Paul, I do believe you're 100% right. I mean, we obviously have some, you know, we would have some bigger clout or bigger with our suppliers, but in the same time saying that, I would believe both Jeff and our current suppliers of our product types and what we do is, you know, we have good partners. You know, would this, you know, reduce some of their risk and possibly, you know, get them some more business as a combined entity? Absolutely. I think that's the name of the game. We've always looked for good partners, and that's how we've been able to stay profitable. So, you know, are we going to see a 50% haircut on all of our input materials and go forwards? Absolutely not. But we will see some strength together. We will see some strength in buying power, you know, in larger volumes, larger numbers. You know, in the past, I believe as both of us have grown, we've taken, you know, a very large number of input materials to run both the businesses. Ours, you know, we know we do in ours as well at the BHO. So those type of opportunities, I guess, are going to be definitely more fruitful for all. And by that I mean saying, you know, we've got this broad range of product types and products, and you know, when it comes to our suppliers, whether it's our plastics and tubing manufacturers, our bag manufacturers, you know, scale is always good. You know, it's good for them. They've got large, you know, large manufacturing facilities they'd like to fill up. You know, and that does change that for sure. But you know, I just want to say that I don't think we're going to be, you know, obviously the bigger the bully comes, because I think we all have good, you know, we really have good partnerships, and we want to continue those going forwards with the people we do have.
Yeah. And honestly, with those partnerships, you know, what we've found and what we expect here is a lot of cross-selling, right? Like, whereas before, when we didn't do pre-rolling, there was tons of times where we're just, you know, recommending our competitors to do pre-rolling services for someone that we're selling a product to. And you know, with this type of an arrangement where our manufacturing capability is so broad in scope, we can capture almost all of those opportunities now. And so not only is it very beneficial, you know, as Travis noted, from a procurement perspective and economies of scale, but I think it, you know, can help to drive some revenue growth as well.
Guys, we're hearing more and more about international sales. Maybe let's talk about how this sort of new platform is able to take advantage of selling internationally.
Yeah, great question. I mean, we've successfully launched and sold our first sale into Portugal as of, I guess it would be January of this year. You know, we've seen that get transformed into a European product, a European sale. So more and more focus starts to become on maybe not the flower sales over in Europe, but definitely becomes focus on what product types these two houses hold, and that's the 2.0 products of tomorrow. And you know, I've had lots of conversations with guys that have been over there and seen the industry, and we've been there, and really, I want to say that, you know, I think our expertise can help push that, you know, product line and that 2.0 segment along a lot faster than what we've seen in Canada. So exciting times over, you know, when we start to see the European market unfold as we are, and with our product lines that we do have in house. We've got great partnerships that we can get, you know, again, leverage for shipping products and moving products in Europe, and we're gaining those day by day, and based on what product types we have. So huge opportunity for both of us in the European markets for sure, especially in the 2.0 derivatives that we both play in. You know, whether that be the solventless side of things or, you know, the BHO side concentrates. You know, our award-winning Phoenix tiers and our capsules, our THC capsules are gaining traction as they do here, but they're also getting huge questions over in Europe. So I mean, capsules we have on testing right now, you know, on stability testing, so that can start entering into the market over there. Stuff like that is it's going to be mind blowing on how big this industry can be, you know, when the rest of the world starts coming around to it.
Yeah. And Jeff, anything that you want to add?
Yeah. So, I mean, in particular, right? So you have, of course, a rush to capture international sales from all LPs, well, a lot of LPs in Canada. And a lot of these LPs have not achieved success here yet. So really what they're doing is exporting an unsuccessful business model that doesn't have proof of concept. And, you know, and that's, you know, not to say all of them aren't successful here. There's certainly some that have been successful here they're, you know, generating significant international business, but we're starting from a proof of concept on operational execution and results. and then now we're going to export that. And so we believe that, as a lot of these companies are plowing the road to international sales and breaking down some of the barriers and allowing it to be an efficient business, we are now just starting to capitalize on those roads that have been plowed with a successful business model and a successful track record behind us. And so we think it, potentially it's a leg up for us. Potentially a lot of the players, one has to wonder what's going to happen to price compression internationally. What's the production capability in foreign markets? What's their power? What's their labor costs? What's their cash cost of cultivation? Well, that could impact us going forward. But being a good operator is always going to win at the end of the day. And we're strong operators. And so, it's a huge opportunity, untapped resource for Simply. Stigma's ahead of us on the international. Obviously, with Delta 9 now, we have a GACP cultivation asset at scale. So, of course, international will be a focus of that asset. And with Travis and his team, I believe that those sales are going to be driven a lot harder because those relationships are already in place. And there's already an opportunity to capture velocity there. So, huge upside internationally.
I want to stick to this slide, but start taking some questions that have come in, and then we can come back. And I've got a few more questions that I'll ask as well if they're not covered by the guys here. So why don't we jump on these questions now? Travis, this is going to be a question for you. It's from Rahil. It says some of the marijuana companies are trading at 8 to 9 times EV to trailing 12-month EBITDA, such as Cannara Biotech. Why CanadaBis decided to sell at a cheaper multiple?
Yeah. Hey, Rahil, how are you? Yeah, I mean that's a great question, and for our shareholders, and I know you're definitely one of them. So for our shareholders, selling at a larger multiple into a share deal or into something that may not be as secure, I think history has proven that's not the be all end all. We really believe we really believe that. I guess the right dance partner was important for us and important for going forward for our shareholders to see that revenue growth and see that share price increase at a level that's going to be sustainable. I don't think anybody that's in with us would appreciate, selling at call it a 10x and seeing their investment cut in a half or a third, a month later, 2 months later, 3 months later by, again, not, people that are not in control of their spending. So that really pushes me into a place where we were looking for somebody that was responsible with their capital, that had obviously some growth potential going forwards, and was not on a rampant train to, I use the old example of how do we get a 10 million square feet today because that's going to satisfy somebody tomorrow. But we really didn't think this through. So that was what Jeff and his group have built within SSC. And that's really what attracted us to it. So yeah, maybe short term, we still seen obviously an upside to our current share price, which was great. And we should be proud of that. But the growth, the potential is in the growth here between these two companies, and these two companies forming something that has not been done in the country yet under a public company setting, really should show, and hopefully we've shown responsibility in the past that will show responsibility going in the future, and we should see some really nice uplift with this thing for all shareholders.
Mm-hmm. I mean, I think I have to chime in here because there's a couple of things that I recognize. And first off, you didn't take a cash offer. This is shares, so you're trying to get the upside of the combination. I think this is a case where 1 + 1 at least equals 3. So I think the value should be determined after the synergies rather than before. And quite frankly, I think the hash shares are cheap as well. So you're sort of getting cheap shares in return for maybe a discounted value. But again, you get the combination. So I think this is a huge win-win for everybody in a lot of different ways. So I have a hard time saying anybody loses here. That's the thing. I see a lot of winners here. So congrats on that. Okay, so next question comes in from Nolan. He says, are the 1/3 consideration shares subject to any earnouts, or is this just for trading/liquidity reasons? You guys know what that question means? I think I saw somewhere where a large portion of the shares are escrowed. I think is not the right word, but restricted to some degree. Maybe we can talk a bit about that.
Yeah, we've it kind of, I guess it goes back into the belief of the story and the belief of again, we didn't take cash consideration for this in the instance that we believe in the story and we believe in, it was going to go one way or another. Either we were going to acquire somebody that was, profitable and looking along the lines and trying to grow the story, or, we came along and Jeff had essentially beat us to the punch on, I'm going to say, a little bit of size to this deal. But at the end of the day, we really believe in, and we believe in, we were trying to find partners that believed in it as well, that, this is a little bit of a longer term play. We're in it now. Let's make the best out of it. Those that got out early in the 2019, 2020 days, good on them. Congratulations. That was the dream of everybody had, but now we're shifting our focus to say this is a real viable business. It's not going anywhere. We're not going to see, cannabis users walk away tomorrow and say, oh, we're done with this. We're good. This is an industry that's here to stay, and we just need to make sure that we're playing in it correctly. And that's part of that long-term belief. And I think we show, from an insider perspective, and that's really what the lockup is portioned to. And, we show that this is a long-term. We're not here saying to all of our shareholders, thanks for coming out. We appreciate you, but you're now Jeff's problem. We're involved in the business. We want to stay involved in the business because we believe in the business. That's really where it focuses from us. So that's part of the shares, definitely the shares that are locked up. And it was just I'm going to say, a gesture of good faith for sure, and shows our true strong belief in the two companies being combined.
Awesome. Awesome. Okay, next question. Mark says, I may have this wrong, but my sense is you have a lot of smaller sized listings in an environment where the provinces are reducing smaller SKUs or moving them to flow through and OCS. Any thoughts on this?
I would say,
Go ahead, Jeff.
by and large, a lot of that rationalization has already taken place. For us, we're having a lot of flow through listings in Ontario being transferred to stock positions. And so it's definitely a concern. But I think that's a concern that has somewhat, for us at least, and Travis can speak for Stigma, but has passed, and that we've weathered the storm, and we've actually capitalized on it, and now we're in a position where they're taking stock positions, which is advantageous. And so there is a natural turnover of SKUs in the industry. You don't want to be on the SKU treadmill all the time. You want good velocity in core SKUs. But some of it is natural. But again, part of the critical mass, part of developing relationships with key accounts at retail, part of having more meaningful conversations and a more meaningful voice in those conversations as a bigger entity, it matters. So I don't personally view that as a material concern at all. Certainly for a lot of the very small licensed producers that have been on the SKU treadmill doing excessive product launches for a very long time, they will be rationalized. For us, our positions of inventory in the warehouses are appropriate for our sales levels and velocities. So personally, I don't see a big risk in our business of SKU rationalization.
No, yeah, and I mean ours is actually the opposite, which has been going well. As we've gained respect with OCS and to into flow through, we've had a lot of our SKUs. I mean, don't get me wrong, there's been some that have definitely fallen off that have maybe underperformed or what have you. And not everything's going to hit in all provinces the same. We find there's a very different product SKU set in Alberta, BC than there is in Ontario, and vice versa. However, a lot of our SKUs now are pushed from flow through actually up into general, and as we go forward with our new listings, I'd have to look at the exact numbers. As of yesterday, we got a bunch. I think we got 9 new listings in Ontario, but a majority of those are going straight into general and not they're kind of bypassing that flow through, which is showing us strength in the market in Ontario, which it is constantly growing for us along the line. So it's strong strength. However, it's it is an indication that we're going to have to be careful on what SKUs we do put in, and as pro forma entity, what ones are we putting in, what ones are working, and what's going forward. And it's all inventory / SKU management, and that's a day-to-day concern on any level.
Mm. I mean, I mentioned that. I mean, you're carrying a fair number of brands. Is there any thoughts around consolidating the brands, if that makes sense?
Not for me. I mean, that's the funny thing, Paul, is I view it as an advantage.
Okay.
But that's because I maybe have an atypical view of where this industry is going. Obviously, I believe in consolidation. I believe consolidation is required. I think that there's too much redundancy in the industry, whether it be with infrastructure, people, you name it. But I personally believe that the LP space is moving towards an oligopoly. If you look historically in Canada, almost all regulated industries end up in an oligopoly, and you kind of want to be one of those oligopoly participants at the end of the day. But then there's going to be a time where consolidation has largely been completed within the manufacturing and cultivation aspects of the cannabis business. And at that time, I think there's going to be vertical integration into retail. And so if you're going to vertically integrate, or for us, downstream into retail, for them upstream into manufacturing, you need to be able to fill a store with brands and products that are differentiated and where the consumer has choice. Whereas if you're a very large LP with 2 or 3 brands and you vertically integrate into retail, you got 3 brands in the whole store. And the consumer just doesn't want 3 brands. The consumer wants choice, especially in this industry. They want to change. They want to try new products, and and they're not as sticky as a lot of industries so far, which can be looked at as a negative. But I believe that this setup is better for the future of the industry.
It's very interesting you bring that up. I'm trying to think, like, in that regard, like, are you missing anything? What holes you need to fill to sort of fulfill that strategy then?
Yeah, and so for us, we launched our first beverages under our Astrolab brand, so it's live rosin infused beverages. They're a huge hit. It's they're huge velocity. Lots of progress there. We've launched edibles, which is a very, very challenging market. And then ultimately with the Delta 9 acquisition, we're not proceeding with the Delta 9 brand. We've called it Humble Grow Co. And we're working on some CPG brand within Humble. But with that, in terms of product category participation will be largely set. And with Stigma, I mean, they participate in even more product categories, and their innovation has been very, very leading edge, especially with things like the daily dabber pouches and things like that. Phoenix Tears were a really good launch. And Travis, so what do you think about that in terms of category participation and capabilities in that regard?
Yeah, I mean, it's going to be tough to tell where the industry goes in a, in a short term. I mean, I think we're going to see, we're going to see changes as regulations change, as again, as consolidation play comes into effect. But I don't know. I mean, branding is such a unique thing in the space where I don't really feel that it's a harm, to have multiple brands and multiple branding in there. And same thing as it boils down to the retail stores. I mean, we have such an individual lineup within those brands and those brand houses, and like you say, if it goes into a retail play versus being pushed down or vice versa being pushed up, we've got it covered. I mean, we don't have a huge miss on anything, and I'm not saying we don't have a huge miss. Maybe there is a product line or something that maybe somebody might want to see. We have the innovation and the know-how and the drive to bring it, and that's we've always said to the provincial bodies or to our customers, and that's essentially when we were in retail, we wanted that feedback back, is to understand, what are we missing? What are we missing? Are we missing a specific product type, or is it a specific flavor, or is it a specific feel or look to something? And that's really that key feedback that we need. But there's nothing we can't do, and that's the differentiator between us as we're executors. Jeff's an execution company as well, obviously, that shows in the numbers and shows in what we do. So we're not worried about really pushing that down the line and saying we have to grab this person because it's a huge miss on our part. I think this is a really nice combination that way.
That's fantastic. Okay, let's take on another question here. And this is probably in the minds of a lot of people, and this goes to Jeff. Jeff, you've been on an M&A tear. Is it time for a breather, or do you have others in sight?
I mean, there's always a pipeline of opportunities, and it, you have to be thorough in evaluating and understanding them. In our positioning and with our core competency in acquisitions and integration of acquisitions, more importantly, we don't feel pressure. We don't feel stress from integration. It's a part of our daily lives. It's something we're very good at. Murray Brown, our COO, current COO, just absolutely fantastic with it. And what we're doing, in a lot of cases previously up until now, is we're bringing best practices in, right? We're helping. We're improving businesses. And so, in terms of a pinch point or a risk for us, we don't feel it's a risk, and we believe that the upside of our strategic positioning with this track record of M&A, with the access to capital, and the core competencies of our team, we believe it would be a huge disservice to our shareholders to not capitalize on opportunities that meet our thresholds in terms of profitability, revenue growth, complementary capabilities, you name it. And we do believe that the industry will be an oligopoly. And we believe that we are in a position to be in one of those oligopoly participants within a reasonable time frame moving forward. We believe that the upside of pursuing that strategy far, far outweighs just a purely organic growth strategy, which we have been adept at. Our two house brands, Astrolab and Fruity Hootie, grew 420% in revenue in 2024. But when you look at this deal as an example, this isn't a distressed acquisition. This is two successful companies coming together and on an accretive basis, first of all, but bringing significant scale. I mean, Stigma's at 35 million a year revenue. It would take us half a year or a year, probably a year, at a 50% growth rate from today. It would take a year to achieve that kind of revenue growth. And so when you're able to do these transactions, when you have a group like Stigma wanting to participate in the upside and taking all shares, and it's an accretive to this degree, 30 to 50% accretive on a per share basis still, those are opportunities that you cannot turn away. The opportunity is too pervasive, the upside is too great, and we have, you know, too much of a track record of successfully integrating businesses and coming together with companies.
Yeah, I think it's really important everybody really focuses on the fact that on a per share basis, these sort of transactions are extremely beneficial to shareholders. So good on you for that. Okay, so next question, again, another one from Mark. Can you talk about how much flower you purchase from other LPs / outdoor, greenhouse, indoor, and any impact on you of wholesale flower inflation? I don't know who wants to take that one on.
No, I mean, I guess we both can, but I mean, we do a lot of purchasing and a lot of things. There's always, I guess there's always a risk of flower inflation, but what we see with that is it really should affect all the way down the value chain. So, I mean, if, you know, a bag or an ounce at the store is going to start to go up, you know, the producer of producing that product is obviously maybe going to move their target price up. You know, we're going to having to pay more, and yeah, there's going to be a little bit of a chain reaction in there, but I think, you know, at some point, I'm not saying it needs to happen from the bottom end, but I think prices need to start moving up in the right direction slightly over the years. I mean, cannabis is one of the few, if any, industries in the last 8 years that is taking a negative inflation, and a really harsh negative inflation. I mean, we're looking at, you know, price compression of, you know, 100+% or more in year over year. I mean, this was targeted to be a $10 a gram product, you know, not very far ago, because I mean, I can remember it clearly. So we're looking 2018, 2019, we're looking at a price target of $10, which is what the taxation is based on still to this day. And you know, I got to ask myself, well, at one point in time, where's the bottom? And I really think we're there. I think we're there from what people can sustain to stay alive, you know, making pennies and just hoping and wishing and praying that this is going to be better next year. It can't get worse for pricing. I mean, I really can't. So as this starts to march up and march across the board, you know, you're starting to see it in stores now. Some of the bigger players are moving their ounce prices up, you know, north of $100, which, you know, really does it, you know, it makes a difference. And there's going to be that who gets paid first scenario, whether is the farmer that gets paid first, is it the, you know, the processor, middleman like we kind of are, or is it the retail store, or who is actually getting paid first? And there'll be some back and forth of that for sure, based on what agreements we have and what we do. But realistically, the whole market needs to swing in the proper direction. And you know, deals like this can't do anything but help that. So, you know, as I'm going to say, the CCAA desperation starts to go away, you know, hopefully soon, that price compression should slow down or stop and start reversing in the way where we all want to see the prices move. So is a risk, yes, but I think that risk comes with an advantage all across the board of, you know, prices need to move in the right direction.
You guys, it's a combination. You guys are still net buyers of flour, correct? I mean, if the price of flour goes up significantly, it's going to impact your, let's say, your costs of material. But at the same time, you still have some capacity, if I understand correctly, to increase your growing capability. Is that correct?
Yeah, and so ultimately, you know, the mandate is we sell the top quality flour into the dried flour markets, capitalizing on these price increases and the demand that we're seeing. As Travis mentioned, the funded capacity era is over. The glut of inventory has, you know, been largely depleted. We are seeing upward price pressure, and we just acquired a 98,000 square foot high quality indoor cultivation asset. So we can capitalize on that. And then in terms of the B products, the small flour, the trim, things like that, all of that will go to Stigma and Massive Hash Factory and ANC for for either extraction or pre-rolling. So reducing the amount of that product that we need to buy externally. In terms of Delta or in Humble GrowCo, sorry, I need to say Humble, not Delta.
Get used to it, yeah.
You know, Humble GrowCo, it's, you know, the facility has incredible upside in capacity. So for about a $4 million retrofit, we can double capacity from approximately 8,000 or 9,000 kilograms a year up to about 15,000 to 18,000 kilograms a year. And so, you know, $4 million is not a material capital investment for that type of a growth profile. You know, we don't have plans to invest that capital near term, but having that asset and the upside there and the production capability is huge for our business plan to capitalize on these prices.
Mm-hmm. That's awesome. Awesome. Thank you for that. Okay, so Mark says, really helpful answer so far, guys. Any worries about OCS or another province arbitrarily reducing your SKU count because as an organization, they feel you have too many? I've heard that this has happened in the past, so I want to lay my concerns there.
Great question. I mean, great question, Mark. I think I would say over branding within one house, one LP probably does have that effect, and we've definitely heard that effect, and that's part and parcel to doing some of these transactions. Is, you know, we can only come out with so many brands out of one house, and when you're talking to our provincial reps, they look at it on a holistic standpoint of you know, one LP having how many SKUs, you know, they got to spread that across X amount. They've got their mandates. However, you know, when you start spreading that amongst separate LPs, that changes. They look at it on a different basis of, you know, that is a separate entity. It's got a separate license. You know, we have a separate sales into that provincial body. So it is separated in a fashion that, you know, we believe that we're not going to have cannibalization of our SKUs within that, you know, within that rationalization in the provincial bodies. More so, I think they're going to look at it from maybe a bit of an advantage standpoint, that they know they're getting quality. They know that our deliverable times are on time. We say we do what we do. Those sort of things are very important for them, because when they're trying to launch a product, and let's face it, they're there to make money too. They're part of a government body, but they've got a mandate to, you know, to sell products that are, you know, profitable to, you know, whether it's AGLC, BCLB, or OCS. If they don't sell them, they don't move off the shelves, people don't reorder. So, you know, when they have that confidence within a couple of groups and they're gaining confidence daily with both of our groups, it bodes well for both parties. They want products that sell. They want the taxation on it. They don't want products that they have to return and, you know, and try and do a ton of RTVs and send back to people that, you know, it doesn't work, right? So when they get that comfortable level with us, which they have, it becomes easy.
Guys, I had a question that come in here, and you've partially answered it already, but I want to refocus on this because I think this is one of the big takeaways of this opportunity here. But in the press release, you mentioned a $5 million $5 million in synergy savings. I think approximately $7 million in adjusted EBITDA from this transaction. Can maybe even at a slightly high level, where are you going to get those $5 million worth of synergies?
Yeah, I mean, it's, you know, a lot of manufacturing synergies, a lot of synergies on the manufacturing of pre-rolls, you know, even things as simple as logistics. And if you look at our asset base, you know, with this transaction, we have 5 licensed producers. And so, you know, we haven't committed to anything yet, but there's a very good chance that there could be rationalization of facilities, you know, capturing velocity within fewer facilities. Those types of rationalizations are, you know, $1.5 million, $2 million a year just by themselves. And so, you know, with the 5 million, we internally, I'm not going to go into details on a lot. Some of this stuff is proprietary and we have competitive advantages that we want to maintain. But, you know, the 5 million, we feel like we're being conservative with that. I think there's just a huge runway in cost savings, you know, both in facility, team, manufacturing, procurement, you name it.
Public company costs, guys.
Yeah,
You know, we look
exactly.
at, you know,
G&A, like the G&A component is huge.
yeah. Even in
Gotcha.
synergies, I know it sounds really stupid, but even synergistically within insurance profiles, within, you know, whether it be a D&O insurance or an operating insurance or, you know, bond, you know, creating bonds versus having to pay cash out to the different parties. That's, you know, it just starts to add up really quick. So
Yeah. No,
Yeah,
perfect,
and that's,
perfect.
you know, the industry needs this, right? Like the industry doesn't need however many public cannabis companies. You know, that administrative burden of public company costs is very, very material, and they don't get any cheaper. And so, you know, as Travis noted, you know, one of the primary synergies certainly is public company costs, legal, as it's related. You know, all the G&A side of the business is big, right? And so when you're taking profitable organizations that are both incurring costs like that, it becomes an exercise where we're not trying to find challenging synergies. It's a lot of low-hanging fruit that is available, but you know, especially at this level, right? Whereas for Simply going back, where you know where the acquisitions are privates or a subsidiary of a public company, there are no rationalization opportunities in things like G&A public company costs. But in this case, at this level where you're taking two, you know, substantial licensed producers with meaningful revenue and they're both public, you know, you're all of a sudden the rationalizations become very low-hanging fruit.
Well said. Well said. Thank you for that, guys. I'm going to take a couple more questions from the audience, and then we'll wrap up with my last questions, and we can let the guys go here. We talked about flower likely bottoming. The question again comes in from Mark, and as a matter of fact, Chris is sort of the same question. But why not increase growing capacity right now? Why not, Jeff? You know, spend the $4 million in increasing capacity at Humble Grow, and maybe taking advantage of the international market. What's your thoughts around that?
Well, you know, obviously financing is always a consideration, and what's the best use of proceeds for capital that's available. And when we're sitting here and we're, you know, look at this deal. And this is an outlier because, you know, it's so unique in that the Stigma shareholders want continued upside. They see that the multiple is low. They see the, you know, the competitive advantages that we have. But this was a no cash deal. And so what I'm saying is that for very modest levels of cash, you can do very, very meaningful things. And so for us, you know, use of proceeds of $4 million could probably add $50 million revenue, or, you know, $10 million EBITDA type thing. So it's really just a strategic decision to deploy capital where it's going to have the biggest impact, contribute most to the company on a per share basis. And for us right now, that's into acquisition opportunities.
Gotcha. Right now it's the buy versus build idea. It makes more sense to buy than build. Yeah.
Absolutely.
I gotcha. Okay. I lied. One more question. This comes in from Martin. This will be the last one from the audience here. What do you think will ultimately happen to your competitors that don't pay their excise tax bill? Guys, Travis, I'll let you take this one. Hopefully they something happens, yeah, which is starting to happen. But maybe Travis, talk to what you're seeing out there.
Yeah, I mean, it's a great question. I think at the end of the day, there's you know, there's competitors that have and there's competitors that have really maybe over leveraged on the excise tax utilization. I mean, out of necessity or whether it's, you know, what have you. I think there has to be some opportunity for repayment. to the government. And I mean, at the end of the day, the government gets their pound of flesh. That's just the way it is. I think, I think they're starting to get fed up with what's going on in the industry. But in the same aspect, I mean, they have to recognize, and they do recognize a bit that, this isn't a industry that isn't overtaxed. I think you talk to we've had a couple of conferences and we've talked to some people in industry, and their general consensus is that, everybody does realize that it's overtaxed. Now, that's not a reason to not pay your tax bill, don't get me wrong, but at the end of the day, I think there's some consideration there, knowing that this is a new industry. The dollar value isn't there, and when you look at some of these places, and us included, we're at 46% tax now. Combining with Jeff on this, the idea is to reduce that tax burden down into the 30s. That's a big difference. But if you're trying to grow and you're trying to move and you're trying to have, some validity in the market with very limited capital available, it's a tough go, right? And it's a slippery slope that can get pinched on really quickly. So I feel for the guys that have a huge tax bill, but at the end of the day, the government's going to get their money.
Yeah. And overall, it really, I think that question needs to be kind of bifurcated into different categories. Like if you have an entity with a significant amount of secured debt and a large excise bill, that's a problem, because the secured lender, especially if it's, other than a large bank, they're not going to just let the capital go out to the CRA when they could basically push the entity into CCAA and take their capital back out. And so we've seen over the last year and a half a significant reckoning, obviously, within the industry of the players that had really material amounts of debt that were significantly over levered, with the 10, $15 million excise bills. And so we've largely come through that part of the industry, I believe. There could be a couple of other significant CCAAs, but when you have this situation like that, really it becomes an opportunity for companies like us. And in terms of this chart here, I don't even know why I turned it to this chart, but it's actually applicable because in terms of the assets that you can acquire. So for example, Delta 9. I mean, so with Delta 9, $3 million cash consideration. The reason that we were able to get this deal for $3 million cash when we got $3 million of working capital in the deal, and we're adding $7.3 million of property, plant, and equipment. So we're paying negative $7.3 million, if you can see there, in the consideration net of assets acquired. And that doesn't include the tax pools, right? So we value those tax pools at about $12.5 million. It's $60 million worth of tax pools for us, assuming we use them. As profitable companies coming here, joining with Travis and Stigma, we're even more profitable. We have use for material amounts of tax pools. We basically got paid $20 million to acquire that asset. So what happens to these entities with significant tax bills and excise bills that they can't pay when they have secured debt is that we have the opportunity to come in and provide value to our shareholders through that process. And so, we don't know what opportunity lies ahead in that regard, but it's good for our business plan.
Mm-hmm. I was going to say that you don't necessarily want to see it disappear too quickly until you've had your chance to eat as much as you can at the buffet.
Well, there's also entities, Paul, and sorry to there's entities that have gone through CCAA that are now beautifully clean balance sheets with substantial operations and profitability, right? So whether you're able to transact before CCAA, whether you transact during the CCAA process, or whether it's after the CCAA process, there's opportunities each way.
Mhm. Mhm. Yeah, and it doesn't seem like they're stopping anytime soon here. Guys, the combination of the two businesses, kind of where does it put you in the ecosystem in terms of size? I heard somebody mention at some point, I can't remember when, but you guys, are you a top 10 player now in Canada?
Yeah, I believe so. Yeah.
Yeah,
Okay.
and I think both short-term and long-term, I think with the synergistic values and the way we can push this model here, we're there all day long. I mean,
Mhm.
we've got great brands, we've got great product size. This isn't stopping.
Yeah, this is the
So,
foundation, right? This is the
yeah.
launch pad. We're top 10 without question now. As noted earlier, in certain categories, top 5 and even almost number 1 in certain categories. This is the beginning. I think that we truly have an opportunity here to achieve something very special in fairly short order, to where not only are we top 10, we can achieve top 5, but with profitability done right, with good fundamentals and free cash flow. And so there's a number of really solid players out there that have differentiated themselves in the industry, call it 2 or 3. And this opportunity for us is really, we look at it as the launch pad. I mean, look at this. It's, EBITDA multiple on the top, net income as a percentage of revenue on the bottom. So there's clearly 2 outliers there with Ayercan and NextLeaf. But even without the outliers, we're talking a 15 times average EBITDA multiple in this industry. Pro forma I believe it was at 63 cents. Pro forma, we're tracking to a 3.9 times adjusted EBITDA. Well, we must have a horrible profitability or a stinker of a balance sheet. Well, no, we're the most profitable LP in the country from what we know, from what we can figure out. We are the most profitable LP in the country from a net income percentage basis. So, in terms of driving valuation with our current revenue level and current EBITDA level, we believe that there's a lot of upside there. But this is the foundation to launch from. We simply, we were fortunate. We ended up on the Venture 50 last year. And, one of our early shareholders and co-founders said, you know what, this is one of the greatest achievements of my career. And this is a 65-year-old gentleman who's, been in oil and gas his whole career, done multiple startups, multiple sales, highly successful guy. And I said, yeah, but you know what? We can do it again this year. That's the growth potential that we have now that we've been able to join with Travis and Stigma and take this to a level of critical mass to where it's truly a foundation to launch from.
Guys, I mean, tremendous amount of M&A opportunity still in front of you. It sounds like you guys believe there's a lot of organic growth opportunities in front of you. As we wrap up here, maybe, I usually try to get a key takeaway from you guys. So maybe both of you give me sort of a message you want to make sure everybody walks away with. We'll start with you, Jeff, and then we'll finish with Travis.
Sure. So for me, it's just, first of all, thank you for, the support of all of our shareholders and prospective shareholders, and Paul and Trevor, of course. But for me, it's just about, we're in such a depressed industry. There's such opportunity in that. And it's about allocating capital into the right vehicle. And I just believe we're an incredible vehicle to drive forward with into the future and to capitalize on these opportunities. And so for me, that's the key takeaway is we're fundamentally undervalued in a very, very challenging and distressed industry. And I believe that we're novelly positioned to capitalize on that.
Travis, your turn.
Yeah, well, first and foremost, I want to thank, obviously, Small Cap Discoveries. I mean, you guys have, over the past year and your support, or I guess 2 years coming up now, even more your support, and just the truthfulness of this whole event. It's kind of I'm going to say it's a bit of a special moment for us because it really helped us gain some traction. It gained obviously some amazing shareholders, and we truly believe in what you guys do. You find the diamonds in the rough, and thank you for that. And thanks for being truthful with it too. I mean, it's the promotions and the promoter. I mean, we get 100 different guys that we're trying to promote, and that's not what this is. This is a truly an honest finding. You guys are genuine with it, and that's awesome. So we want to thank you, and thanks for our shareholders for CanadaBis Capital. I mean, it's been a great run. We really truly believe in this pro forma entity. Going forwards, Jeff. I think Jeff and I will do an amazing job for everybody, as we have done in the past. And I just, I really would like to say thank you, and that we do believe it. So, come on in. It's time to get in with a company that, if you're not a current shareholder and you're obviously watching this and going through it, do your homework, see what's going on in the industry, but really have a look that this is an honest and real run business, and we're going to continue to do something great. So thanks again, and we appreciate it.
Well, listen, guys, thank you guys. Congratulations, by the way. You guys have done, I think and should continue to do some great things as far as creating value for shareholders. We are obviously big fans of what you guys are doing, and the cheering you hear off in the distance is us clapping as loud as we can. So continued success. And again, really appreciate the time you spent with us. We've been speaking with Travis McIntyre, CEO of CanadaBis Capital, CANB on the Venture Exchange, and Jeff Swainson, CEO of Simply Solventless Concentrates, HASH on the Venture Exchange. One last time, guys, thanks. And we really look forward to catching up with you guys the next time we've got something more important to say.
Thanks, Trevor. Thanks, Paul. Sure appreciate it.
Yeah. Thanks, Paul. Thanks, Trevor.